Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. The ULIP illusion returns. That viral comparison conveniently omits what matters most: your money and your family's protection. Every few months, a slick comparison chart circulates in WhatsApp and social media, claiming to prove that ULIPs are superior to mutual funds. The latest version ticks all the right boxes: insurance cover, tax benefits, flexibility, discipline, and death benefits. It looks convincing because every fact stated is technically correct. Yet it represents one of the most successful pieces of financial misinformation in circulation today. The deception lies not in what it says, but in what it carefully avoids mentioning. Let me be direct. This comparison is structured to mislead you about the most fundamental question in personal finance: how to properly protect your family and grow your wealth. It does so by bundling two entirely different financial needs together and pretending this bundling serves your interests rather than the insurance industry's profits. Begin with the most fundamental issue: having adequate life insurance. As I've written repeatedly over the years, any person with dependents who earns an income needs life insurance equal to at least 10 times their annual income. Now here's the mathematics that the ULIP promoters hope you won't do. Life cover in ULIPs is typically 10 times the annual premium. This creates an impossible situation. If your annual income is 10 lakh rupees, you need 1 crore rupees of life cover. To get 1 crore rupees of cover through a ULIP, you must pay 10 lakh rupees as annual premium. But that's your entire income. The structure of ULIPs ensures they cannot provide adequate life insurance at any reasonable cost. This is not a bug, it's a deliberate feature. Meanwhile, proper term insurance can provide a 1 crore rupee cover for perhaps 30,000 rupees annually at age 30. The difference can be invested in mutual funds, creating wealth while your family stays genuinely protected. Let's address the tax argument, as the comparison highlights the completely tax-free maturity offered by ULIPs. Yes, ULIP maturity is tax-exempt under current rules, but this benefit is meaningless if the underlying returns are poor, which they typically are. ULIPs are deliberately complex structures with multiple layers of charges: premium allocation charges, policy administration charges, fund management charges, mortality charges, surrender charges, and more. These charges are neither transparent nor comparable to the expense ratios of mutual funds. The mutual fund industry operates under stringent regulations that cap expenses, mandate transparency, and protect investor interests. ULIPs operate in a different regulatory universe, one designed for traditional insurance products rather than investment vehicles. This regulatory arbitrage enables insurance companies to charge fees that would be considered scandalous in the mutual fund industry. The comparison celebrates the 5-year lock-in as a means of enforcing disciplined savings. This is Orwellian language. Lock-in isn't discipline, it's captivity. If you face a job loss, medical emergency, or any financial crisis during those 5 years, your money remains trapped. Real discipline comes from understanding your goals and maintaining commitment, not from contractual penalties. The death benefit comparison reveals the fundamental dishonesty of the entire argument. The comparison states that ULIP nominees receive sum assured or fund value, whichever is higher, as if this is a generous provision. However, remember that the sum assured in a ULIP is inadequate by design. If you die with insufficient life cover, your family receives insufficient money, whether it comes from a ULIP or any other source. The correct approach, which I have advocated for years, completely separates insurance from investment. Buy adequate term insurance first. Say a 1 crore rupee cover for 30,000 rupees, your family is now genuinely protected. Then invest the remainder in mutual funds, choosing from transparent, liquid, low-cost options that have consistently outperformed insurance-wrapped investments. If tragedy strikes, your family receives 1 crore rupees from the term insurance policy plus the value of your mutual fund investments. This combination provides far more protection and better investment returns than any ULIP. The viral comparison you're seeing isn't accidental. It's part of a sophisticated effort to make ULIPs appear superior by carefully controlling what information is presented and what is omitted. Every fact stated might be true, But the conclusion is false because the most important facts about adequate insurance coverage, true costs, investment performance, and flexibility are systematically excluded. When you see these comparisons, ask yourself, why must insurance and investment be bundled together? Why can't I purchase the amount of insurance I actually need separate from my investments? The answers reveal whose interests are truly being served, and they aren't yours.